Right. Good afternoon, everybody. And for those people logging on, maybe you can, in the chat box, you can give a shout out to all the team that we've got here today. Maybe where you're from. Good to all have you on board today. I can see you're logging in. So official good afternoon to everybody and welcome to today's High Impact Real Estate webinar. Our topic for today is unlocking real estate value in uncertain times. Auctions, assets, and the economic road ahead, which I'm sure everybody's keen to find out. I'm Neale Petersen. I'm the founder and editor-in-chief of Real Estate Investor, and I'll be your moderator for what promises to be a power-packed, insightful session. And a special welcome to all our attendees joining from across South Africa. Great. So tell us, give us a shout out where you are. And also we get visitors abroad as well from time to time. And thank you for investing your time with us today. And for those new to REI, welcome. Since 2007, we've been a trusted voice to the South African property space. Our mission is simple: to inform, connect, and empower property investors, professionals, and entrepreneurs. And we do this through our monthly magazine, Real Estate Investor, the rei.co.za property news and learning platform, and our weekly webinars, interviews, and newsletters. And we also do live events, seminars, and networking opportunities. Just go to rei.co.za. So today's session is proudly brought to you by, of course, in partnership with High Street Auctions. They are South Africa's premier property marketplace. And for those of you who don't know High Street, they established in 2010. They've become the country's leading property auction house, setting record-breaking sales and offering unmatched expertise to sellers and investors nationwide with deep real estate experience and a full empowered status. And they provide real-time opportunities in a rapidly shifting market. So before we dive into some housekeeping, session will run for 60 minutes. Use the Q&A box, not the chat box below, to submit questions. We'll deal with it at the end, and we'll cover as many as possible in the live segment. This webinar is being recorded. The replay link will be shared with all registrants by email. You can go to the rei.co.za website. So let's talk about what we're going to be learning about today. And let's face it, South Africa's property market is under pressure. I mean, there's political uncertainty, there's inflation, there's rising interest rates, and volatile investor sentiment. I mean, they definitely are reshaping the game. But in every market shift, opportunity doesn't disappear. It simply moves. So today we'll unpack where it's moving and how you can position yourself to take advantage. So over the next hour, we'll explore 4 key themes shaping the property value in 2025, the economic reality check, understanding the macro forces driving property trends, auctions as a real-time barometer, how auctions reveal what buyers truly value, and where the smart money is going, investor psychology and capital flows in uncertain times. And then lastly, we'll talk about opportunity amid disruption, how savvy investors are positioning for the rebound. So without further ado, we're joined by 2 outstanding thought leaders. First of all, Professor Adrian Saville. He's leading economist, strategist, and faculty member at GIBS. And Adrian brings decades of experience analyzing global and local markets and helping us understand how politics, interest rates, and sentiment are shaping real estate investment today. Welcome to you today, Adrian. A shout out to the audience.
Neale, thank you. Great to be with you and to be with Greg. Lovely opportunity. Welcome to everyone who's joined the webinar. Thank you for your investment of time. Neale, I wish you were saying I have years of experience rather than decades. But
okay, we'll change it to years. Excellent, great having you on, Adrian. And then, of course, we got Greg Dart. Greg is a director at High Street Auctions. They are a pioneer in South Africa's auction industry with a proven track record of unlocking value. And I mean, Greg really has a frontline view of which assets are moving, who's buying, why auctions are often the market's most transparent value indicator. Welcome to you, Greg. Great having you on board.
Thank you, Neale. Thank you, Adrian. It's a privilege to have been invited to the panel. Neale, I think this is probably your and my 5th sitting together, yes, talking to various topics. So It's a comfortable place to be with you, alongside you as the moderator. Welcome, everybody. And just to, I suppose, lighten the mood a little, Adrian was saying as he stepped in that he had a haircut for the occasion. Neale and I made the point that although he's trimmed back and looks wonderful, he hasn't hit the baseline that you and I have as the baldies in the group. But nonetheless, you look great. You look great, Adrian. And just a point to our guest today, we've also, as High Street Auction, we are one of the main sponsors for SARIPA's conference at the end of the year in October. SARIPA, South African Restructuring and Solvency Practitioners Authority. And we're very proud to host Adrian as the keynote speaker and a moderator of one of the panels down there too. So looking forward to that event.
Absolutely. Great having you, and great having you. I really look forward to our discussion today. So Adrian, I'm going to start off with you. I mean, by setting the scene, the political outlook. I know you've got some slides, and we will then follow up with a Q&A discussion. So Adrian, maybe just talking about the uncertainty around politics, tariffs, interest rates, sentiment. I mean, what are the key economic signals you're watching? And what do they mean for the economy and real estate value in South Africa today? Are we stabilizing? So I really look forward to your initial presentation. So over to you, Adrian.
Sure. Thank you, Neale. Let me just pop up a couple of slides and try and use this as a lens to get some perspective on South Africa's circumstance. For wider readers or for parents of kids who have a single-digit age group, this picture might be, immediately familiar. It references Alice Through the Looking Glass, Lewis Carroll's Alice in Wonderland. This book is written in 1871, 150 years ago, and I'm hard-pressed to think of a book that is more poignant and pertinent in making commentary on the landscape now. Because what happens when Alice goes through the looking glass, old-fashioned word for a mirror, in her family living room, an old-fashioned word for a lounge, the world in this wonderful adventure goes upside down and back to front. That's what happens. That's what mirrors do. They reverse the image. And I think that that is exactly what has happened in a global setting. And a point of departure in commenting on South Africa, I think it always equips us to step up and out before we step down and in. Because South Africa is a small, open, commodity-driven economy, and having that lens on the world is, I think, offers a very rich perspective. So if we think about some of the movements in a global setting, the gold price moves from $2,000 an ounce to $3,500 an ounce in the space of 24 months. That's fantastically good news for South Africa, in particular for marginal gold miners who have been lifted into fantastic profitability. Platinum has recently joined that pack, with the platinum price up 40% over the course of this year. Then you've got brand new emergent businesses or not brand new, but in their emergence, brand new or recent. 5 years ago, few people had the word NVIDIA on their lips. Now it trades place with Microsoft for world's largest market capitalization. And then through the course of the last year or two, India overtakes China to become the world's largest population. And the fact that China's population is now shrinking with a shrinking workforce starts to pull the rug under the potential performance of their economy. So there's lots of change afoot, and I've been able to get, through 2 slides without saying Trump. We'll come to him in a second. What I want to pay, particular emphasis or attention to is, in this global setting, the big mover over the last 12, 18 months has been geopolitical. 2024, by percentage of people going to the polls, was the most democratic year ever. There's no year in history where we've had more people going to polls as a percentage of world population than 24. That in itself is a remarkable statistic. What's even more remarkable is that in 2/3 of those elections, there was a change in political power. And much like the way in which we buy cars, we vote the same way. The badge that you bought last on your vehicle is likely to be the badge that you buy next. The party you voted for last is likely to be the party you vote for next. And so we have change of leadership in Mexico. Bangladesh, they oust their leader after 1 month. Macron calls a snap election in France. He's snapped to reality. Botswana, this government has been in power for the better part of 60 years, and they deposed. The UK goes from Conservative to Labour. India must form a coalition government. And of course, South Africa must form a government of national unity. And then, we get Trump right at the end of the year in November. But the world isn't done. And as recently as the weekend before last, Japan went to the polls, where, guess what? Thematically, there's a change in power. So I think that we find ourselves, on a global stage that has been reset for the next 5 years and potentially the next 10 years. And alongside that political transition, you've also got economic forces that are changing place. BRICS now accounts for a larger share of world GDP than the G7, and that is a train that is steadily steaming ahead. And this crocodile jaws is going to go wider and wider. So in terms of making your real estate investment positioning, thinking strategically about where you go and how you go and what you buy and why, there's two big stories in the political movers and the economic movers, and being careful to keep in mind that South Africa, is the S in BRICS, with people often cynically, commenting on, oh, well, it's a small S. Doesn't change the fact that South Africa is the S in BRICS. The temptation in this landscape is to now spend our time forecasting about what's coming at us. But I show this slide just to remind us how poor we are in forecasting. Sequentially, we've got COVID-19, which strikes in 2020, and that wasn't in people's forecasts and strategy documents. 2021, you've got inflation sitting up and going double digit in advanced economies. 22, oil prices under Russia-Ukraine go from $60 to $120. 23, GPT emerges. 24, we've made the point about elections. And 25, we've got war in the Middle East. We've got tariffs. 25 isn't done yet, so I'm not sure what the big word is for 25. But it equips us to just think carefully about what we imagined in January of each of those years and what the year landed up looking like. My argument being that perhaps spend less time fussing about the forecasts and more time thinking about, have you got an investment approach that is fit for a changing and uncertain circumstance. Now let's step down into South Africa. Over a number of years, I'll go to you, Neale, over decades, I've been building the 6-factor model, which aggregates the ingredients that explain countries' economic growth structure. This is really important because growth structure is one of the biggest drivers of social well-being, of institutional stability, like democracy being an institution that does better under rising incomes per person, and company performance does better under a higher GDP growth. So, the economy matters. Economic growth really matters. The green spine that you see on the left-hand side here speaks to all of Africa. The red spot is, it says Botswana. That red spot should say world. That's my PowerPoint skills that have gone askew. But I want to highlight, the world in terms of its growth potential. And here's the really good news. In this very changed environment, the world growth structure looks largely unchanged. So the drivers remain intact and stable. That's good news from an investment perspective, and it might be even better news for a small open economy that is keyed into world economic growth. Having said all of that, South Africa's growth structure is sluggish and sits no more than modestly above our population growth. So we have to, the imperative for South Africa remains the same. We've got to get out of the talk and into the action on delivering on structural reforms. Under Vulindlela, good progress has been made. So we are in better shape today than 12 months ago, 24 months ago. Think of the number of days you have of uninterrupted energy. And that's part of the structural reform that is afoot, but not nearly enough has been done. So much more is required. And I think, we can now steadily turn our gaze from Eskom, not fully fixed, but a long way out of intensive care, and we turn our attention to the other critical network industry, Transnet, which is doing better and better under Michelle Phillips. So, here I think I might be, a rather unusual South African voice that whilst I'm frustrated by our sluggish performance, I'm feeling more buoyant and optimistic about the progress that is being made. And perhaps, to make particular mention of the political maturity that we have a government of national unity that has been formed and has held together. I'll touch wood, at every turn here, because the challenges are multifaceted and big. But so far so good in terms of a government of national unity. There's another dose of good news for South Africa is, Greg, I recall presenting to your clients at one of your auctions, perhaps towards the end of last year, where I ventured that the Rand had a better handle on the front of it, that it might have a 17 handle or even a 16 handle. And I'll keep saying that when we look from a currency valuation perspective, the Rand has two desirable attributes if you're wearing an investment lens. The first attribute is it is undervalued. And the second attribute, it is a robust currency. And so we refer to these currencies as coiled springs. Who else has a coiled spring? The Japanese yen looks particularly attractive. Botswana, a hard case to make right in this moment, given what's going on with the pula, but it looks undervalued and robust institutional underpin. You can buy some pounds, you can buy some Canadian dollar alongside your Rand and your pula. So if we were a Martian looking for places to invest and you're going to get return from currency first, South Africa looks interesting. And just to keep in mind, though, that when you're considering your currency position, should I allocate to South Africa? Should I allocate to Europe? Should I allocate to Southeast Asia? Always remember that currency is a function of what both are doing. So the fact that the Rand is getting stronger is in part a result of the dollar getting weaker. And I just show here for completeness what has happened in other currencies. So as much as we've got America being made great again, well, the Martians might be looking at this and saying, in global currency terms, Americans are somewhere between 5 and 10% poorer under Trump because of dollar weakness. Let me finish with a quick note on our outlook for South Africa and specifically what it might mean for real estate as an investment class. The data that I show you here is from Rand Merchant Bank's Where to Invest in Africa, where we contribute to this research. And we rank 31 countries in this work across a number of dimensions, all the way from income per person, economic growth structure, institutional stability, innovation, ability to access the market, to ease of doing business in market, and so on. And I don't want it to be lost on us in this webinar that Africa is the second fastest growing region in the world over the last 25 years. Asia is the fastest. Africa has the world's youngest population, so you've got fast growth structure, you have demographic underpin, and the two fastest growing economies in the world over the last 25 years are Rwanda and Ethiopia, not India and China. This is our neighborhood. In this neighborhood of 31 countries that we assess for investability, South Africa ranks right at the top, placed fourth behind small but impressive Seychelles and Mauritius. And South Africa, we're in the process of updating our publication for 2025. That'll be in public domain in the next couple of weeks. But South Africa is holding its own in this dynamic setting. Economic growth, the outlook is frustrating and sluggish. It's not spectacular. Let me put in a couple of economic howevers. And the first however is inflation is tame and stable. We can look forward to ongoing low single-digit inflation at the bottom of the 3 to 6% tunnel. And having said that, I take a high confidence from the Reserve Bank's ambition to go for a 3 target. I think this is very good news for investors, for inflation, for the Rand. Trump and tariffs is a big unknown. Watch 1 August, which is, well, that's tomorrow. And that remains a big risk and an unknown. The Rand, I've already made the point about the attractiveness of the Rand. I don't think it's beyond the realms of possibility that you get a 16 handle on the Rand. And, what then is the implication for real estate? Well, the implication for real estate, I think the one big story is the impact all of this has on interest rates. We've got an interest rate announcement in a couple of hours. You can see how right or wrong I am. And here, I want to do the fence sitting thing. I think I'll be a proper fence sitter here. I think that there is a 50-50 possibility of a 25 basis point cut. I can't do any better than that. And if you put a gun to my head in South African fashion, I'll say I'd rather err on the side of caution, which is the SARB's style, and I'll go with no cut this afternoon. If you put a gun to my head, otherwise I'll say 50-50 on the 25 cut. The big, however, is 2026, I think that there are 2 cuts in the barrel. In 2027, I think that there are 3 cuts in the barrel. So we get to mid 5% interest rates by 2027. That is good news in a steady growth, low inflation environment. That makes a real case for real estate. Let me stop there.
Good, great. Thanks for that, Adrian. I think very interesting. Thank you for setting that scene. I think it's so important. And yes, everybody's waiting with bated breath. I've actually pre-written my newsletter for tomorrow, and I've kept it as
What's your number?
I'm holding. I'm saying it's steady. I'm saying there's no change, and also because I think the South African. Government, well, if you talk about the MPC, I mean, they tend to look at what happens in America. So America have just kept theirs, they've just held theirs. So obviously the Feds have kept theirs. So that's why I'm basing it pretty much on that. They're pretty conservative from historically. But thanks very much for that, Adrian. Yeah, great. Thanks for that. Okay, so Greg, let's talk about your vantage point, because you're the property guy. You the auctions guy. You in the game. So what are you seeing on the ground that reflects this kind of pressure, which Adrian has kind of shared with us, or sentiment that's out there in the market?
I must just comment again to Adrian that you always put your arguments forward so elegantly, and I was very invested in your presentation. I could have let it run for another half hour. That being said, absolutely, looking through the lens of auction, we are seeing that economic pressure, but interestingly also these pockets of confidence. And I see Adrian having given voice to that as well, that he's cautiously optimistic. So just from an economic pressure perspective, we are certainly seeing a lot of distressed listings, Neale. And I know you follow the space and you've seen the work that we're doing in turnaround, restructuring and insolvency space. We are seeing an uptick in distressed sales across non-core nodes, underperforming sectors, your office parks, older hospitality stock, and the likes, secondary markets. And certainly liquidators, banks, business rescue practitioners, they are reaching out to us for a solution, unlocking cash in a high default environment at the moment. And further to that, just looking to your small to medium-sized enterprise, we're certainly seeing a lot of owner-occupier sell-offs. Sluggish consumer demand that Adrian's talking to, input cost pressures, has created a situation where you're seeing a lot of these owner-occupiers offloading to try and raise capital, reduce whatever debt exposures they might have. And we're seeing that in the heavy manufacturing, heavy zones particularly. I follow a lot of what John Lewis says, and I respect a lot of his analysis. And I do follow what he says in terms of the Purchasing Managers Index, and specifically new sales orders. And I've seen that number coming down below that 50% or that 50 index, which talks to this contraction in the manufacturing sector. So we are seeing the SME sector under pressure, and specifically in the manufacturing heavy zones. And on a auction basis, on the floor, we're certainly seeing cautious bidding, and there's definitely valuation sensitivity. Buyers are very price sensitive. Deals are being done. Certainly deals are being done. There's more buyers on the floor. But I think expectations, if they are adjusted to market realities, deals are being done. There are these indicators of emerging confidence. Certainly our investors are chasing high yield. They're looking after well-located assets. So there's cautious, but I'm seeing confidence returning if the fundamentals justify the price. So maybe, Adrian, this talks to the sentiment, an early recovery signal in the cycle from an economy perspective. And we're certainly seeing auctions as a preferred route to market. A lot of our sellers and buyers are choosing auctions as either as a primary sales strategy or an absolute implicit part of their investment strategy. We're seeing repeat sellers coming to the floor. So there's some institutional confidence in auctions. I mean, I certainly have worked with a number of sellers that have come to us a number of times for repeat mandates, and we're getting great results. So it's a great price discovery tool in these uncertain times. So just if I had to create a summary to that, I'd say certainly our economy and how it reflects in the work that we're doing in the property sector and auctions, definitely stressed but not collapsed. There's a lot of selectively confident buyers in the marketplace, and they're adjusting to a new price reality at the moment.
Any regional biases there, Greg? I mean, we talk about, Johannesburg has been under a little bit more pressure. It seems Western Cape seems a little bit more robust. I mean, are you seeing that as well?
Yeah, there's no doubt if one looks at supply and demand, Neale, and again, I can talk to some of John's recent analysis, across the primary segments, your commercial, retail and industrial, the Gauteng region is the most oversupplied. We're finding the least demand across each one of those segments. Cape Town, Western Cape, you're just not getting stock into the market. It's significantly undersupplied. Demand is exceeding supply on all of those three segments. There's an interesting move down in the likes of KZN where you're seeing demand starting to outstrip supply in most of the segments. So that's a new marketplace that we're targeting. Some green shoots of economic positive sentiment in that region. But certainly, if you're talking just the comparison, Gauteng and the Western Cape, outperforming on all levels in the Western Cape, and demand outstripping supply there.
Yeah, great. So Adrian, I think, you mentioned having your investments sort of economically fit, but let's talk. Can you elaborate a bit on that? Because I mean, how do political developments and policy ambiguity affect investor appetite for fixed assets like property, for example? We've got a property audience here, so.
Neale, so I think that the policy uncertainty needs to be separated from political uncertainty. Not to be too clever with words, but political uncertainty, says, always easy to talk about other people's marriages. We're not sure if it's going to be the Conservatives or Labour in charge, or we're not sure if it's going to be the Republicans or the Democrats in charge. That's policy, political uncertainty. Policy uncertainty is when they start moving the furniture around. Where that has happened most dramatically has been in the United States. And you've seen that policy uncertainty index. There's a really neat metric on this. Policy uncertainty index has gone higher than during COVID time. And that isn't good news for investors of all shapes and forms, whether it's fixed assets, public markets, private markets. Uncertainty is a dangerous ingredient for investors. What I find confusing in this environment is, whilst it is the US that has been at the front of feeding this policy uncertainty because of their political changes, US capital markets have powered ahead. And you've got capital markets at record highs. The appetite for assets seems almost insatiable. And I am wondering, quietly, whether there isn't a suspicion that we've got a new interest rate game underway. And the interest rate game in particular is pressure on Jerome Powell. And if he doesn't cut, then we'll find someone who does. Now, let's just stay with that thesis for a moment, because I think that risk is a material one. I'm trying to not use the word real, otherwise it sounds like punning. But I think that is a very material risk. If that is the case, you want inflation hedges in your basket, and those inflation hedges take the form of physical assets, commodities, precious metals, real estate, timber. That's the type of stuff that is going to do best. You want to stay away from bonds, and equities will be okay, but real assets are probably, or if we look at historical evidence, real assets are the big winner in inflationary times, because you get the double whammy of and real estate. Sorry, I said real assets. Real estate is the real winner, because you get the double whammy of the crocodile jaws of your cost of debt falling because you took the debt historically, and that debt is now being written down by inflation, and you've got the price of the asset keeping pace with inflation, as long as it's a functional economy.
Okay, great. Thanks for sharing that. So Greg, let's talk a little bit about. You mentioned obviously auctions it's making a comeback. It's definitely a more reliable way to transact, especially in a market where there's sort of policy sort of uncertainty. Can we maybe just unpack, which are the asset classes that you're seeing that are more in demand on the ground? I mean, commercial, I know you mentioned some commercials, industrial, mixed use, is residential. You also mentioned, obviously, there is some seller distress and obviously more interest and that kind of stuff. So what are you seeing in terms of asset class that's in demand, and where's the activity?
It's just interesting to hear Adrian's last comments, and certainly we're seeing, capital chasing opportunities, despite the distressed market. I'll break it out into the specific segments, but there's a couple of clear themes here, Neale. We know that the auction market at the moment is highly price sensitive. I mentioned that to you, and yield driven. But if you look at the asset classes that people are chasing, it all reflects this income stability. They're looking for some value add potential, and certainly wanting to make sure location is future proof. And, that seems to be underpinning a lot of the decision making. Despite that, let's talk about the segments specifically that we're finding, greatest traction on. Without a doubt, for us, the top performer remains industrial. It's been our bread and butter for, I think, probably the last 2 years. And this continued pressure on the e-commerce growth that we're seeing, supply chain reconfigurations, that continues to drive this interest in this sector. Warehousing, mini units, logistic hubs in key locations are driving our real estate deal flow at the moment. Commercial mixed use certainly remains selectively high in demand. It has to be all about location, though. So it has to be well-positioned urban precincts. We're looking for opportunities for redevelopment, conversion, whether it's conversion to residential, co-working, student housing, and the like. But they have to be realistically priced. As soon as you've got buildings that have got vacancies, any rezoning dependencies and so on, you'll find an interest cooling on those commercial mixed-use type assets. Your other strong pillars in the real estate sector being your retail and commercial office. It depends on what that asset is in the retail. Certainly your high strip retail, your neighborhood strips, essential service tenants, those are continuing to find demand. But your larger malls, your enclosed malls, centers with low footfall areas certainly remain, they certainly continue to face headwinds, there's no doubt. And in terms of office, very limited interest. Unless you've got a conversion play in a residential area, it has to be well let, smaller office components, perhaps in a mixed-use block. The larger corporate head offices being avoided. So that's a segment that really continues to be oversupplied and not enjoying a great deal of demand. I think I saw some analysis not so long ago, perhaps John Lewis again, and I quote if correct, I think he said about 20% of the office space, the vacant office space, is being converted at the moment. So quite a large conversion ratio there. And then I was at your Reside conference a couple of weeks back, Neale, listening on a lot of the panels and so on. These bigger residential portfolios are interesting, but this distressed residential portfolio that you see come into the market sometimes, that's definitely value hunted territory. You're seeing guys that are coming in and looking at purchasing below market entry points, and where there's a rental yield uplift, refurbishment, being able to charge greater rentals later in. And we're seeing a lot of foreign African buyers entering this space as well. So apartment blocks in fringe areas like Yeovil and the like, certainly we're starting to see some traction there. So those are the 4 segments that I would talk to. But again, it's really all about, the income stability of that asset in the right location with value add potential.
Okay, great. Thanks for that. I mean, at one of your auctions, I saw. Yeah, of course. Please add to that, Adrian. Yeah,
I was just going to helicopter in there. First, just as a cheeky aside, I love the turn of phrase Greg has there, value hunters. Wearing my investment hat, that's exactly the mindset and the philosophy you want to bring. You want to hunt, through a careful search process. And in the investment world, a very powerful one-liner is price is what you pay, value is what you get. And we want to hunt for value. So I love that turn of phrase, Greg. But, what you're saying in your comments here, I think that there's really rich, insight in this in terms of the importance of your segment, which segment you're positioned in, and your geography and the type of asset that you've got. And that's quite a powerful sort of 3x3.
Okay,
Thanks,
excellent.
Adrian.
Good. So, and I just want to say to our audience, you got some questions, please. I see there is some. The first question has flown in. Please don't be shy. Fire away with your question in the box there. So, Adrian, I just want to come back to you in terms of the comment that you made with regards to Trump wanting to get rid of Jerome Powell, because almost, Trump is a real estate guy. He's almost trying to control the narrative. And then I know he also plays in crypto markets and those kind of things. So, I mean, is that a good thing? I mean, there's been a lot of noise around that. I mean, to fire your head of Fed and it's almost like a self-serving thing. Well, what are your thoughts around that?
Neale, the concern that I have is that this is a direct challenge or a direct threat to institutional stability. So even if Powell, stands his ground, and he has been quite clear, that he won't be intimidated, he's not stepping down. It doesn't change the fact that you've got a threat to the institutional stability. And if I was looking to allocate capital, I'd be thinking twice about US dollar. I'd be thinking twice about the United States. Now, that's a hard argument to make, given the fact that the greenback has by far been the best performing currency for the last 20 years. The fact that even if it doesn't perform well, it remains the currency of choice, that the United States has been the investment market to be exposed to over the last 20 years or so. So, my suggestion that I'd be having a far more cautious stance on the US flies in the face of recent history. But if you look at the performance of countries once their institutional fabric has been compromised, you don't want your capital in those places. And I don't need to tell this to a South African audience. I don't need to tell this to a Pan-African audience where you've been in an environment where your institutions have been compromised. Zimbabwe, an obvious case in point. So, what Trump's threat, if it were to turn into a reality, I think that it would first mean interest rates heading back down to zero. I think he's more pragmatic than taking us to zero, so he might help interest rates down to 1 with his new chairman of the Fed. And that would quickly be followed by inflation, which would come on top of inflation that's already being built because of the trade corridors and tariff chokes that have been dropped into the inflation cake. So, I can't make sense of this. It flies in the face of all of the things we know about the importance of policy stability, institutional function and form, institutional strength, and so on. It's bad politics and bad economics.
Okay, great. Thanks for that. And so, Greg, let's get a little bit back on the ground again, because you spoke about the different categories and that kind of stuff. That's doing well, that's in demand and all that kind of stuff. So I know stock is also an issue, getting the right stock for the demand and that kind of thing. But maybe you can share, what are the overlooked opportunities that smart investors should be watching right now? The low-hanging fruits. What are you seeing?
Look, there's no doubt, Neale, that distressed sales in the marketplace are an opportunity for any investor, and it should probably be part of a portfolio if one was looking to realize good returns on capital. there is distressed properties in the market. You can buy these trades at 15 to 20% below their replacement value. It's a great entry point for people that are willing to tolerate the legal discourse attached to that property. And any cleanup work that you can do post that transaction will see an upside. So I would say the most opportunistic buy in the market at the moment is probably a distressed residential or commercial lot. You can get it at a good price, and the upside post-transaction is available.
Okay, great. I think that's a good one. And there's another question. I just want to deal with these two questions while we're on that. Zolani asks, is it a great idea as a first-time buyer to buy property on auction? Your thoughts around that, and maybe the pros and cons.
Zolani, absolutely. What we're seeing is that property auctions right now have actually evolved into the market's, I call it de facto early access point. This is where people are finding undervalued and strategically important assets. So if I had to give any advice, 3 reasons why you should participate on auction. It has to be part of your strategy. Auctions aren't for bargains alone. They're actually the most efficient route for a serious deal, for deal flow. And we're finding that more and more sellers are leading with auction. They're not ending with it. So, Adrian has spoken to me in the past. He sees auction as a demand and price discovery platform. And we know that our market is hungry for liquidity, and they're looking for clarity, a hard deal close. And a lot of sellers are in the market, banks clearing non-core assets, funds and REITs looking to rotate portfolios. Our private sellers wanting a speedy and clean exit. So come to auction. It's the front end of the deal funnel often, the heads of brokers and your private listings. And there too, you'll find these undervalued assets. They surface here first, often. Not only do your urgency-driven sellers such as liquidators, BRPs, municipalities use, but we're finding the mainstream market is using auctions to come to market. So mixed-use buildings with poor management but great location, there's an upside. Industrial portfolios needing consolidation, there's a great upside. Resi blocks with a tenant or levy issue, again, a huge upside. So, come to auction. If you're monitoring auctions closely, you can spot value, act ahead of the curve. And I'm also finding a lot of our buyers are using auctions to map pricing trends in real time. You see where the market is at that time. They can benchmark their bid strategy versus actual demand. Where is the market? And I'm finding that auctions are becoming intel hubs. I see a lot of people coming to stand on the outside of the auction, just monitoring where pricing trends are, where demand trends are. So I would urge you, if you're an active investor, somebody that's wanting to invest in real estate, come to the auction platform.
Excellent. Great. Thanks for the Greg.
Neale, can I say something just quickly? My immediate response when I saw that question was, just to start smiling, because as a first-time buyer to go to auction, the challenge you've got, Tolani, with real estate is it's an illiquid market and a thin market. Price discovery is very, very poor. An auction puts on the table for you the market is deeper, the market is richer, and I love the point that Greg's making. You can just sit on the sideline and observe, and you can gather market intelligence. You don't get this in places other than auction.
Great. Okay, so just extending on that, Adrian, if you look at it from a macro perspective, what are the sectors or regions that you think is a little bit overheated or risky right now, other than real estate, of course?
You mean from all asset classes?
Yeah, no, just from a general perspective. I mean, you've talked about currency, you've talked about, just in your thoughts around that. Yeah.
Well, look, I think, notwithstanding the points I made around inflation concerns, I think South African government bonds are particularly interesting, especially if the 3% target comes to fruition, or even better, a 2% target. And then we front loaded with those interest rate cuts. That would make government bonds, and in particular long-dated government bonds, really interesting. Long-dated government bonds and real estate correspond well, so you could drop real estate in. I'm scratching my head. As much as I'm scratching my head about the valuations on US equities, I'm also sort of somewhat surprised by the performance of South African equities. They've done, disproportionately well, and perhaps played a little bit out of their boots. So if people are exposed to equity here, I think you want to be careful about the equity that you're exposed to. If we step out of South Africa, the place that I'm concerned about from a valuation perspective, US.
Okay. All right, great. So, Greg, coming back, I want to deal with these two questions. One, they're two from Kazimula, the one's linked to the other. So there is a mushroom of shopping malls in the far north of Limpopo where I stay. I could see that there's an opportunity for us, which small companies, to take an opportunity. How would you address this, or what is your take on this? And the focus on our side is mostly commercial use and no interest, of very little in the mixed use and residential market in the far. So your thoughts around how they could handle that? Your thoughts there, Greg?
I'm not sure I understand the question, Neale.
I think I think what he's looking for is a way forward to invest in shopping malls, for example. How would he go? What would the approach be? And for example, and if I may say the company's name, I know, for example, you work alongside a financier like Business Partners, who alongside entrepreneurs and who finance entrepreneurs with ventures like this. So I think Kazimula is looking sort of from what is the way forward for smaller companies to take an opportunity. How would you address, or what's your take on this?
So retail has a lot of challenges. It's a very oversupplied sector of the market. And that's why I spoke very specifically about the appeal of your local strip mall, your neighborhood strip mall, from a perspective of convenience, your very particular rental, your tenant profiles. That you've got to be careful that you are trading in an environment where you are going to find that footfall. There's a lot of overtraded spaces. We've got a number of assets that are in the market at the moment where you've got cannibalism of your trade by the very fact that you've got a lot of similar assets in the market. Same anchors, if not the same anchor, the same service offering. So competition, make sure that there is room in that market. There is a gap in that market for you to bring an offering to market. Retail, make sure it is talking to your neighborhood center, your convenience, rather than your larger malls, because you're seeing headwinds on the larger malls. Insofar as actively investing, there are those assets in the market. You've got to buy it at the right price. Make sure that you don't overcapitalize or spend too much on those assets, certainly, so that your returns are commensurate with the risk attached to those types of assets. There are those business partners and the other financiers that will assist, certainly, in building a capacity for you to invest. Furthermore, is it that you're buying into an operational asset, or are you looking to develop from ground up, in which case, you've got to buy the right land, you've got to make sure you've got the appropriate zoning in place, some sort of feasibility as to whether or not it is viable, an investment, if you're looking at a startup in that area, rather than historical data to support your investment case. So there's a lot of things that you have to consider. I'm certainly happy that you give me a call perhaps afterwards, and we can talk about perhaps assets that we've got in the market that you might be interested in investing, and we can give you some further guidance on that too.
Excellent. Great. I think good advice there, Greg. And thanks for sharing that. There's one more question before we get back to you, Adrian, from Patrick. And this one's definitely your question, Greg. How are online auction platforms reshaping bidder behavior and pricing dynamics in commercial property transactions? And what role does data play in driving trust and liquidity? Thanks for that, Patrick, for your question. Greg?
Patrick, so online certainly has a place. It's not dominating the narrative in the auction space. We find that it's a hybrid model that works best for us in the auction space. We like to have engagement with people in the room. We like to have engagement with people on the phone. Online, certainly, where people aren't able to participate, it provides a 24/7 platform to be engaged in that auction, if it's a timed auction or even if it's an auction on a particular day at a particular time. So there's no doubt online bidding plays a role. It's part of the price discovery. We need to ensure that everybody that needs to bid has the platform to bid. That competition unlocks market value ultimately. We steer clear of online only, principally because we believe that a hybrid model with both people in the room competing with each other on the telephone and online creates the best outcome. Online is great in terms of its data. We know who's in and at what price. We use it to drive price on the floor on the day, but we tend to not use it in isolation of those other platforms. So it has a place. Traditionally, our auction on the floor, we find, is delivering the best outputs to our sellers, purely because you tap into the emotion of the buyers on the floor. They are looking each other in the eye. They're willing to compete more aggressively. And therefore, at the end of the day, you extract maximum value. So it's part of a hybrid model. It has a place, and we certainly do use it on the auction floor.
Excellent. Great. Thanks for that. So Adrian, I mean, what is the signal that you see that investors should be watching in the next quarter? What is it looking for? What do we need to? What are the metrics? What is the indications there that we need to look out for, say, in the next quarter going forward?
Perhaps some moderation of the instability and the uncertainty that has been injected over the first half of the year. And I think we can look out for, even look forward to that. I don't want to be naively optimistic, but the acronym that has been earned through the first part of the year is the TACO acronym. Trump always chickens out. And I think investors have actually, after initial reactions were sort of panic, alarm, what we would call overreaction, the responses now seem to have been, well, we expect big talk, big announcements, and then moderation. So I think, what we should be watching for, perhaps even anticipating with a degree of optimism, is a sort of a less animated, less volatile, more stable environment as we settle into Trump approaching midterms. That's been the primary driver of capital market performance, inflation, interest rates. That's been the story of the last 9 months. And I think we can anticipate a better 9 months. I'm not saying that's better for capital markets. I'm saying it's better for stability and certainty and our ability to map direction of travel.
Excellent. Good. I can't believe where the time's gone. We've approached 1 o'clock. So what I'm going to ask to do, Greg, starting with you, give us your sort of final wrap. Maybe you want to leave the audience with one key message that they can take away and use going forward. And I'm going to ask the same for you, Adrian. Can't believe where the time's gone. It's been a fascinating conversation. We need more time. We must maybe do it again, and certainly going forward. And I think the audience has given us some good questions here. So first of all, you, Greg, your parting shots.
Thanks, Neale. Well, firstly, I hope I answered the questions that came to the floor. We can certainly spend more time with those individuals that were asking more about retail and so on. You spoke about what are the other, undervalued plays in the marketplace that perhaps people could invest in. And I'd love to talk to them about, mixed use of residential blocks that we can unlock greater value on, industrial mini parks, where there's upside that we can talk to as well. But just closing comments, I would think that the smart money really now is not really chasing the speculative upside, but they really are looking at preserving capital, securing income, and this unlocking upside through repositioning. And that's why we talk about these other opportunities that perhaps people could invest in. Certainly for investors, people that were listening today, and this volatile climate that we're dealing with, you should treat auctions as one of your first ports of call. You can access these value-driven opportunities. You can gain this critical insight into pricing, your competition, and the demand dynamics that we see on the floor. And, really, from my perspective, auctions are no longer just about bidding, but they are real barometers of sentiment and belief in the future, and a strategic entry point for an informed investment in real estate. So, we've spoken about being in a very fragile but shifting landscape. Investors that move early now on the real assets with this real income, and the courage to act where others are perhaps hesitating, there's caution, those are going to be the winners.
Excellent. Thanks, Greg. That's Greg Dart. He's Director of High Street Auctions. And Adrian, your final parting shots, please.
Yeah, well, Neale, in the interest of time, let me try and be brief. I think what I've really enjoyed in this conversation is getting Greg's insights on the structural underpins. That it's dangerous to see an asset class as a whole. That real estate is geographically different, different by category. It's got different drivers, and the quality of the asset is informed by a range of different elements. Your tenants, if there's arrears, et cetera, et cetera. And if you put an overlay on that lens of my observation about price is what you pay, value is what you get, then I think that if equipped with those two ingredients, what a lovely way to set out in search of hunting value, Greg.
Excellent. That's Professor Adrian Saville of Economics, Finance and Strategy of Gordon Institute of Business Science, GIBS. So great having you, gentlemen. Thank you very much, Adrian. Thank you very much, Greg, I think, for your valuable insight today. For our audience, thank you for joining us and interacting with us today. Join us again next week, next Thursday, the 7th of August at 12 o'clock. We're going to be talking about the PI Act. And we've got the legal minds here, and we're going to be unpacking that in detail. And we're going to be talking about some of the challenges that a lot of investors have had with PI Act. And we should be talking about, should South Africa's eviction law be amended? And we'll be discussing that. So join us next week. There is a link in the chat box, or you can go to the rei.co.za website. So once again, I'd just like to thank Greg and Adrian for their time and input. It's been a great discussion. I think it's got to be continued sometime ahead. And lastly, to say, this is Neale Petersen alongside my two counterparts, Greg and Adrian, signing off until next week. Stay informed, stay empowered, and keep investing wisely.